All right. Good evening, Ken of Tortoise Capital Nightly Strategy Podcast for Sunday, May 16th, 2021. We only have one trade frame posted in the room, so I'm going to cover that one. It's from Chi Wing Chong. It's on U.S. Steel, and he has adopted the weekly, daily, and hourly framework. Let's see. So on the weekly, we have basically the whole material sector and especially the metals have really been working well. We got this summer, fall, summer. So this is a real strong upward signal, and you can see that it sent that up to 30. The daily pullback, this daily pullback region is this region in here. And we've got essentially a kata 2, a couple kata 2s, actually. So if I make that red so you can see it a little easier. Yeah, all these support levels demarked by the RL10. You could even call that one. Now, what makes this one interesting is the falling RL10 now makes this problematic here. So we don't have a support level yet at 2450, but you can see it starting to form here. So this is really early days in the trade. What makes this primarily a day trading and an hourly chart is the fact that we don't yet have the clear demarked bottom of the RL10 like we have here. This one is still falling. So what we have to do instead is look for support. Now, what makes this problematic is that we don't have a higher low. We would like to have seen this like reverse here and go, like it was trying to, but it didn't. So this is really the congestion zone right here between, say, 25 and 26. It's not really positive until it gets above 26 for a swing trade. However, on an intraday trade, we can certainly take this one here and then aim to get to 27 and then 28 and then 29, those little dollar gains. We really want to see it get above 28 in the previous peak of the Bollinger Band mean. Then it's the hump of the dragon. Then it's the RL10. You can see that if it gets above 30, we would certainly want to be long that. So we don't want to give up the opportunity for $4 over in here. So what we can do is play this on a shorter time frame, like maybe the 10-minute, and try to get long here around 26. Get long in there around 26, and then manage that trade intraday. It would not be unusual to see that get above 28 or 27 on the intraday, and then get up to 28. That could happen. You know, we've seen cases before where it comes out of a congestion zone and gives us a nice strong move. Here's another one, nice congestion and a nice strong move. So all we're really hoping to see is this same trade here, and hoping to get to 30. So it's a pure tactical trade from 26 to 30, which is good because that's a 15% move. And then if it gets above 30, then we're free and clear. You can see that would be long gone, and that would be long gone here on the weekly. So that one absolutely works. I would also be ready to play the short side on this one, because if this cracks, then it's down to 22, and so that's minus $4. So again, if you can manage about a 50-cent risk on this one, you'll never take more than one execution risk. but you should be able to take advantage of these sharp daily moves in U.S. steel. So we want to, as far as the sector trading is, we would like to see SPY going up. We'd like to see XLB going up, and we'd like to see XLB better than SPY. And we'd like to see U.S. steel going up and better than XLB. So if you get that whole logic chain going, then this will be a really good move on Monday. Okay, so that's the only trade frame we have posted. Wish there was more, but it is what it is. I want to, since we're here, I want to take the opportunity to do a summary of a really important lesson from yesterday's Q&A session with the foundations guys, right? And it has to do with decision making. And the question is, where do you put the energy? Where should you be putting your energy for improvement? Because we want to do continuous improvement, but with all the choices for improvements, where do we want to spend that? So when it comes to decision making, here's how I view that. The first decision that we're going to make is an entry decision. All right, which means that we took a look at the setup conditions and filters and all that stuff, and then something about that said, yes, the trade frame is good, and then we get a signal that allows us to enter. Okay, so we have some kind of trade frame that has a defined entry, a defined initial risk, and that initial risk is the execution risk, which tells us that the hypothesis of the trade is wrong. And then we have some kind of reasonable target. And this is going to be 2 times position sizing risk. And if we set our execution risk, this yellow zone down in here, where it hasn't signaled to enter or to stop and reverse or anything in that exit zone, that risk we want to set to 0.2 position sizing risk. Okay, so this execution risk, this is a signal that the hypothesis failed. Right? Now, if we are framing a critical state, then that's defined as a larger than normal probability of a larger than normal move in either direction in a short period of time. So it would be convenient to array that as a doji, right? Because that's the absolute balance point between bulls and bears. So if the initial risk that I'm taking to my capital is 0.2, and I've found some reasonable 2 times position sizing risk, in other words, this thing could actually get up to here under reasonable and normal circumstances, then really what I'm looking for are trade frames where I have 10 execution risks available. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's how the math works out. So I'm really holding out for really significant moves in either direction. I typically like the ones that featured a harsh sell-off that brought it down to that doji, because this ordinarily incorporates some fear, and so there's a very emotional condition that's baked into the cake. But that emotion of fear has been balanced by the greed of buyers who have come in and have temporarily neutralized the fear, and so we have this creative tension. Now, the smaller the critical state, the easier it is to see normal moves generating 10 execution risks. So we really want the minimum manageable risk box. We want that thing to be compressed into the tightest little range we can, which is why we love the Z3P, the super pinch, or the max pain range compression, where we had a large sell-off that terminated in a little doji. And then if that just stayed in some kind of long, quiet state, why, that's where we would see those Z3 lines compress. And then the breakout in either direction gives us a really favorable move at a minimum of risk to our capital. And then if it does break out to the upside, and we get our little entry here, then our job is simply to get our initial risk out of the market and get to no lose plus dinner for two. Now I've locked in some gain, and now it's a science project. To me, the next critical one is when can I lock in an average win? So if I know my histogram and this thing has gone beyond my average win for that particular pattern, how soon now can I lock in my average win? And now any exit that I take that's north of the average win is going to move my histogram. It's going to move the average win to the right and improve my overall stats. Microscopically, but inevitably and mathematically. Right. So if that's the general frame of reference for hybrid trading and strategy trading, that first decision that we have is, do I enter? And so that's a function of the setup and the filter, and do I have time, will, pattern, and money? Time, will, pattern, and money. The pattern tells you the specifics of the setup, the filter, the framing, the logic behind it. The will is the zero state. The time says I have enough time to be able to achieve normal gains. And that's normally an issue of, for the intraday trades. Is there enough time left in the day? Swing trades, it's usually less of an issue, unless we're looking at, proximity to earnings or something like that. And then money, it's really just, that's just numbers. Do I have risk capital that's available? And if I have those four things, then I can trade. All right. So the entry decision is really a combination of skill and confidence. Skill in that I am setting up the template correctly and I have framed the trade correctly. And then confidence is to be able to pull the trigger and trading it at a level of risk that's justified by the skill and confidence. So those two things. Now, once we've got the entry in, and this thing is going to move up until we get an exit decision. There is a series of decisions that we're going to make about when to move to no lose plus dinner for two and how we're going to adjust those stops. And in every case, what we're really doing is reevaluating the reward to risk ratio of the trade in that moment. If I have established some reasonable upside gain, at the moment of entry, I have the maximum reasonable gain possible. And then as this thing starts moving in my favor, I have less and less reward remaining. And so I can't afford to just keep my initial risk in, because now like as we say in the 2R battle drill, with only 1 penny to go to 2R, I'm really risking, $2.99 in order to capture 1 more penny of gain. And so my reward to risk ratio is askew. So really this idea of locking in gains is an effort to not get shaken out by noise, but wherever the signal is, the one that says it's no longer noise, it's signal that this trade is failing, that I'm exiting there when I have reason to believe that the hypothesis just failed or it doesn't go any further. Well, it turns out that each one of these decisions is identical. You have some kind of reward to risk ratio that started with an initial reward that's still in place, and then the risk, which is where you're proposing to put your stop, and that's being informed by where's the signal that tells me that trade is over. So you're trying to find a balance between giving it room to run so you're not kicked out by noise, but also not sticking around after you've received a legitimate signal that the trade is over. So if you want to be excellent and consistent and disciplined, you realize that all of those decisions are the same decisions. And every one of them looks like the 2R battle drill. And there's how much would I be willing right now to give back before I preserve the gains that I have in hand. And that's a reward to risk ratio, continuously and dynamic. So if I get good at this decision, then I'm just repeating that same excellent decision all the time. And if there were 10 decisions in this, and one of them was to enter, and the 10th one was to actually exit, then 2 through 9, those 8 are really just management decisions. So I want to be really good at those. And then you realize that, oh yeah, the exit decision was not an extra decision you made if you're just following your mechanical rules. It just happened that price moved against you and it hit the stop, and the price and the trade and the market decided, not you. So all you really have been doing is managing your exit in the standard way, and when it's time to get out, the market tells you when it's time to get out. The only footnote to that is if we have elected to use a sniper technique in addition to our manager technique. And conceptually and emotionally, I think of the manager as the passive rules, standard passive rules on how we're going to adjust the stop mechanically, by trailing it with the frog box, or trailing it with the initial risk, or using the PSAR, or using the edge of the dragon, or using the Bollinger Band mean, or something like that. Something where he is following the SOP in his little handbook. I think of the sniper as the active trader who is looking at the specifics of the context that we're in, to saying, there is some special information about how price is behaving that is going to override the simple rule set of the manager, which was compiled after hundreds of trading cases. And so maybe the specifics of the context or something, like, for example, hey, price has been riding the Z2 line comfortably, and then makes one big last bold move beyond Z3, closes, and then it can't make a new high and is starting to fail, and we just decide, you know what, that looks like the exhaustion run, so I'm just going to strike. And just take it right there. Whereas the manager exit might have been way down here at the Bollinger Band mean, or it might have been here at the PSAR. But for some reason, I've decided to accelerate that. So if you are, when you first start trying this on, you could have a mindset which says, is it the sniper or the manager? So it's sniper versus the manager. Which is the right one? We've come to the conclusion that you just dedicate half the position to the manager and half the position to the sniper. And then when your trader's judgment tells you, for whatever reasons you've decided, it's time to execute the sniper exit, then take half the position and then keep half with the manager. And you'll end up over time getting the halfway trade-off between the sniper and the manager. And it eliminates all the emotional angst about deciding which one is correct all the time. You just say, I'm going to split the difference, and I'm going to eliminate the cognitive effort of making those decisions. And what that will do in the long run is preserve your emotional resilience. It will improve your willpower because you're not depleting it by constantly wondering which is correct, the sniper or the manager. So you're actually building up your endurance and your resilience in your emotional bank account by being able to stay in the zero state by adopting a strategy that allows you to harmonize and accommodate both of those compelling arguments. Because you can find thousands of cases where the sniper was the right one, or 1,000 cases where the manager was the right one. And there's no one single rule set that gives them a dominating position, in my view. So I just say I'm going to take half and half. And then sometimes the sniper will get you out of half the position, and then the price will recover without ever hitting the manager and starts to resume. And so you just say, all right, I'll put the half a position back on. And then the manager feels smug and smart. But then there's other times when you take the sniper, and then it comes down and hits the manager and continues to fail, and say, oh, well, the sniper was really smart because he would have captured that extra little piece of that position. So the sniper is smart. So you can find any number of cases in which the sniper is right on that case or the manager was right on that case. So I've just found that the half and half just eliminates all of that second guessing and internal talk and allows me just to concentrate on managing the large histogram of trades. And then my study of the manager exit allows me to fine-tune the way I'm managing it with standard passive rules. But I keep the sniper active because that's the source of my creativity and innovation. So Ken asks, on the path up to the 2R point, the reward risk potential gets smaller. Should we consider smaller position sizing when adding scoops? I prefer just adding standard sizes, so it's like standard bullets and just keep going. That's just that way I reduce the thinking, but I could also live with a 3-2-1 approach where you're getting maybe 300 shares and 200 shares and 100 shares because of that diminishing returns, but it still allows you to scale. Either one of those feels reasonable. The smaller that my little minimum manageable risk box gets, the more I kind of like the standard position sizing. So I get, 200, then 200, then 200 quick, fast, and in a hurry. If I'm getting 3 positions in routinely a lot, I kind of like 2, 2, and 2. But if I'm getting the first one in good and then the second one quick, and sometimes I never even get to the third one, I'd rather get the 500 of the 600 shares on early. And in my view, you start wanting to trade at a position size on the first trade that even if that's the only one that you get, that it's still giving you the good payoff that makes it justified. So that's what I would say. Luke says this is so pivotal to trade management. Yeah, correct, because now you can compare using the histogram. You can look at the trader quality number versus the system quality number. So the system quality number is derived from the managerial exit, the standard passive rules. And the TQN is derived from the sniper. And when you have enough standard exits in both, like if you have a standard way of applying the sniper, like, hey, I'm just going to take half at the PSAR and half at the Bollinger Band mean for the manager, you can over time just take a look at the TQN versus the SQN and see which one you like better, without all of the angst and the anxiety that makes you change your rules on each and every trade. Just have sort of a standard way to accommodate the sniper and the manager, and now you can manage your histogram instead of the emotions inside the trade. You want to use your creativity and analytical thinking outside of the trade. You don't want to do that while you're driving the car, thinking about existential questions. You want to just be executing. You want to have a state of zero state or no mind, which is pure action that is based on, rules and practice and battle drill, standard practice. You want to be thinking about it when you're looking at the data set of your histogram. Okay, so that's what I wanted to say about that. So in conclusion, by concentrating on the managerial decisions about how to move it, you're going to improve your consistency and discipline and professionalism. And then you realize that the exit is really just one more. It was just the last managerial move you made, and then price got you out. And unless you're using the sniper, but you're at some point deciding, hey, once I get past an average trade, once I get past the average win, that's probably when I want to start thinking about the sniper, because now I have more to protect. Up until the average win, I think you can do that just with standard passive rules. That's the way I'm developing those ideas. And by that time, what I really am looking for is, once I get 3 execution risks in, or 0.6 position sizing risk, that's about where I want to start engaging the sniper. Because by that time, I probably have 2 positions in and it feels like it's working, and I'm going to make a nice gain. What you end up realizing then is that the entry is really just another form of the managerial exit, only you didn't even have any skin in the game, and you have no gains to protect. What you are trying to protect is the opportunity to make gains. And then you realize that the entry is just a special form of the manager's exit. And the difference between them is that on the entry, you don't have any skin in the game. Now you have skin in the game. And now that becomes more emotionally significant, perhaps. And the anxiety that comes from the entry is the recognition that you're about to have skin in the game. And that's the difference between stalking, when you're just on the outside looking to get in, and then at the moment of entry, you're now inside that trade. You got skin in the game, and now it's game on. Okay? So that's what I wanted to say about that lesson, and probably make that, I'll extract that as a video. I thought that went pretty well. Let me know if you found that to be helpful, and I'll now return you to your regularly scheduled program.